Teledoc stock is getting absolutely crushed, down nearly 40% after hours. What is going on? I'm going to talk about Teledoc stock, their first quarter 2022 earnings, why it's down, and my thoughts about its potential longer term. What do I think it could do over time, and what it'll take for that to happen. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. In full disclosure, I do own a teensy-weensy bit of Teledoc stock. Now, how do I own and why do I own Teledoc? Well, I actually originally got my shares from Livongo, which Teledoc acquired for $18.5 billion in cash and stock. And just to show you what a bad deal that was, here it is. They're talking about a goodwill impairment of $6.6 billion. Okay, let me take a step back to explain that. So when you make an acquisition, oftentimes you're paying a lot more than the actual physical assets of a company. That difference between what you pay and those physical assets gets attributed to goodwill or intangible assets. If the value of that business that you acquire ultimately isn't worth it, then you have to write that down. And so here it is. This effectively, management says, oh, it's because our stock price is down. But the reality is this is effectively calling out that the marketplace thinks that the acquisitions they made aren't worth it. And think about it. They spent, between cash and stock, $18.5 billion to acquire Livongo, their whole company. And keep in mind, they bought a whole bunch of other assets as well. The whole company now is only worth $5.6 billion. So this reflects the market is saying, whoa, you are terrible at capital allocation. We do not trust you. There's been a lot of cash burn. And that's actually what they're also recognizing with their latest earnings report, saying, yeah, we're facing this. It's a non-cash charge, but it's a huge charge of $6.6 billion, writing down that goodwill. Now, the stock's also down because they're guiding to lower growth, 15 to 19% growth in the next quarter. Lower growth for the full year. They previously guided to between 2.5 and 2.6. Now it's between 2.4 and 2.5, and also lower profitability. Okay, so what's going on here, and why is the stock getting so beaten up by this? Well, there's a couple of things that you should consider. First of all, the main reason why they're reporting and guiding to lower growth and profitability really comes from that red alert, that red flag word, competition. And whenever I hear that, that means, you're not unrivaled. So this is the reason why if Teledoc stays part of my journey, it's personally, I'm not going to be scaling up anytime soon until I get some greater clarity on, will you be able to beat competition? Will you be able to kick their butt? And what management is saying, you know what? There's all these little smaller competitors. They don't have all the solutions that we have, that we sell to our end customers, these businesses, these healthcare plans, that want to offer virtual care, this telehealth to their employees. And so here it is. They're saying, yeah, we have this full suite of solutions, but these smaller players, they're eating away at us. They're chipping away at our market, and that is turning into a problem for them. So they're saying, yeah, we're not growing as fast as we'd like on the direct-to-consumer side, particularly, looking at, let's say, some mental health products that they have. They're seeing a lot more competition there. They're also saying the return on investment for ad spend is also a lot worse than they're expecting, partly, once again, because of that increased competition. So that is a red flag for me, as I'm looking at these results, and it's something I want to keep in mind. I'd say an even bigger red flag is the fact that just a few weeks ago, management was talking about, yeah, we've guided to 25 to 30% growth. We have high visibility, I would say, into this ramp. So we're talking about high visibility when it comes to revenue. That's problematic for me. And this is the reason why Wall Street is completely, blowing out of Teladoc stock right now, down nearly 40%, is you cannot say a few weeks before a call where you lower guidance that you have high visibility into this. This means you lied effectively. This means that you were wrong just a few weeks ago. And so you don't have high visibility if all of a sudden you go from 25 to 30% to 18 to 23%. That is really problematic. Credibility for management has gone out the window, and it's gotten even worse by the fact that they're talking about, oh yeah, we expect nice margin progression over time throughout the course of 2022. And what do you actually see? You actually see, yes, revenue did grow very nicely, 25%, but their profitability actually got worse. Their margins got worse. So you can't say, oh yeah, our profitability is going to get better over time, when that's not what you're seeing with the results. So you're looking at one data point after another, marks against management where they either don't have a good feel for the visibility of their business, or they're overpaying for assets, being terrible capital allocators. This is being really problematic. These different data points. So I think what Wall Street is saying, this is a vote, no confidence, thumbs down. You got to, effectively get management out of there. I think in order for me to personally, consider scaling up Teledoc, which at this point it's a teeny tiny position, no way would I consider it based on the current setup with existing management, which is that you would need to have a change in management effectively come in to say, hey, this is how we're going to run it. We're focusing on return on invested capital. And if we're not growing at 25%, but we're only growing 5 to 15%, but we're profitable, that might be the way for them to pull it. Now, look, you pull it back a little bit, understanding the business. Their core business is access fees, which is effectively selling the right to companies, healthcare plans, that they provide healthcare, that they provide telehealth, and that's an option for them to offer to their employees or healthcare plans. And so this business, they do have high visibility here, but their direct-to-consumer business, like mental health, that's come under pressure, not growing as fast as they'd like. Plus, they are seeing some competition with the access fee business, but still growing at a reasonable clip. U.S. paid members still growing at a reasonable clip. Average U.S. revenue per member still growing at a nice clip. And you see utilization. This is a really important metric to understand, which is that it's going up over time. And this implies, we have a solid value proposition that people are using. Once again, the challenge is that you have these smaller players sort of eating away at the deals that they could potentially be winning. And so that will hurt their growth, will hurt their margins. Now they are, still unprofitable. If you look at their cash flow statement, this isn't their cash flow statement, but if you look at their cash flow statement, they're still $60 million in cash burn. This is an unprofitable business. And that makes it tough for it to get a nice valuation when you're looking at slowing growth and cash burn and significant losses. So what is Teledoc worth, and how should we think about the valuation? First, if you're interested in following along or trying to find stocks, potential multi-baggers that you can buy right now, I just updated my website, unraveledinvesting.com. So now it is easier than ever to find past and current potential multi-baggers, as well as I share my own personal journey. It's cheaper and better than ever. And I'm currently running a limited time discount. That's at unraveledinvesting.com. And so how do we think about managing the risks with Teledoc and the things that would, the things you need to consider before, let's say, scaling up? For me personally, they do have $1.5 billion in debt. Management loves to call out, we have $800 million in cash. Well, you're burning $60 million a quarter. And so that means you're actually going to have a lot less cash within the next few years if you keep that up. But you also have $1.5 billion in debt. It was convertible debt, so debt that could convert in stock if debt holders wanted to, but the stock price of Teledoc is down so much that these debt holders will want to get paid in cash. And so they're going to have to figure out, how are we going to pay these convertible bonds in the future? And that's $1.5 billion. And so that's a core risk that the market needs to think about. Does that mean significant share issuance in the future, significant dilution at really low prices to sort of pay for this? That is a concern that I think the market is going to need to understand before rewarding this at a higher multiple. I think you're going to need to see management get the boot. This is just too many bad things happen. You can't have these huge goodwill impairments. That's because of their decisions. You can't have them guiding to growth and then weeks later not delivering. And this is just consistently all these different marks saying, we're not delivering. And so I think ultimately, in order for the stock to recover, management does need to get the boot. And so I'm not showing the detailed valuation framework here. I'm going to save that for my Unraveled Investing subscribers. But, as I think about it just broadly, look, this is now trading at 2 to 3 times sales. Right now it shows 4 times here, but that's before the 40% drop in the after hours. So you need a huge turnaround, in order to get a satisfactory return. You're going to need to get from, let's say, 2 times sales to 4 times sales or 6 times sales. I personally think it's possible. And keep in mind, if you go from 2 to 3 times sales to 4, 6, 8 times sales, well, if that happens, then you have a situation where the stock can go up hundreds of percent. That is the upside potential if you successfully deal with the issues I'm talking about. And I'd say first and foremost, the first issue is management. You got to deal with management, get management that you can trust in there that says, hey, this is what's going on. We're going to deliver. This point, Wall Street does not trust them. They are getting the gladiator thumbs down by the market, and it's by their own behavior too, overpaying for several assets, $6 billion write down. So that's a key aspect. So once again, you're not going to get that re-rating, I don't think. And keep in mind, this channel's, this is Unrivaled Investing. This is not financial advice. I'm sharing my own personal take on this. I don't think the stock gets that re-rating until you see a change up with management that, investors can believe. And then another example is saying, hey, not only are we new management coming in to turn this ship around, but we also have a plan saying, hey, this is our sweet spot. This is our strength. We have nearly 70% gross margins. This is how we're going to leverage this into a profitable business. Because right now they're significantly unprofitable. Could you get to 20%, 30% operating margins over time? That's what they're going to need to do in order for the stock price to work out over time, because that's ultimately, as a shareholder, you need to get that free cash flow. Now it's cash burn. They're losing market share arguably because competitors are eating away at smaller deals. And so this is a challenge for them looking at this. And so I look at this and say, yeah, it does have that potential if you see a real turnaround in their business. And by the way, they have to deal with $1.5 billion in debt that they don't have the cash for at this point. So how are they going to handle that risk as well? So that is a lot of red flags to consider. It's tough for me to go like, oh yeah, make a big bet. I was enticed, by the potential of telehealth and the fact that they were growing so quickly. And originally I just got it because they bought my Livongo shares. So I have a tiny position in Teledoc. As you can tell, I'm not looking to scale it up until several factors come in. Management that you can trust, clear plan that you can sort of track over time. Whatever plans management have, gone out the window because you can't trust them. And so you need to see clear plan to say, hey, we are going to be profitable very soon. And even if growth isn't what we expected, yeah, we're going to be hitting our margins. And this is our value proposition. Anywho, if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.